In Chapter 8, we will learn how organizations achieve their financial goals by preparing budgets. Learning Objective 1 is to understand why organizations budget and the processes they use to create budgets. Managerial accounting focuses on three activities: planning, controlling, and decision-making. For planning, developing budgets is an important part. What's a budget? A budget is a detailed plan for a future which is normally expressed in formal quantitative terms. Let's take a look at advantages of budgeting. Budgets define goals and objectives, which can serve as benchmarks for evaluating subsequent performance. Budgets force managers to think about and plan for the future. The budgeting process provides a way of allocating resources to those parts of our organization where they can be used most effectively. The budgeting process can uncover potential bottlenecks before they occur. Budgets also coordinate activities of our entire organization by integrating various plans. Budgets communicate management plans throughout the organization. There are two types of budgets. Operating budgets normally cover a one-year period, corresponding to a company's fiscal year. Many companies divide their annual budget into 4 quarters. In this chapter, we will focus on one-year operating budgets. The other budget is a continuous budget, which is a 12-month budget which rolls forward 1 month or quarter as the current month or quarter is completed. This approach keeps managers focused on the future at least 1 year ahead. Let's take a look at the overview of the master budget. The master budget includes a number of separate but interdependent budgets. This chart illustrates the interdependency of the various individual budgets. We start from the sales budget. The sales budget shows expected sales in both units and dollar amount. It's normally based on the company's sales forecast. All other parts of the master budget are dependent on the sales budget. Then we can prepare the production budget. The production budget lists a number of units which must be produced during each budget period to meet sales needs and to provide for the designed ending inventory. The production budget influences direct materials, direct labor, and manufacturer overhead budgets. And then we can prepare ending inventory budget. Meanwhile, we can prepare the selling administrative budget. For the cash budget, the cash budget is a detailed plan showing how cash resources will be acquired and used over the period of time. All of the operating budgets have an impact on the cash budget. The last step is to prepare a budgeted income statement and budgeted balance sheet. Now, let's take a look at these budgets one by one. Let's first take a look at how to prepare a sales budget, including a schedule of expected cash collections. We will use Royer Company as an example. Royer Company is preparing budgets for the quarter ending June 30th. Budgeted sales for the next 5 months are in units, from April to August. For these numbers, budgeted sales in units can be obtained from the company's sales forecast. Selling price is $10 per unit. Based on information here, we will first prepare the sales budget. We can prepare the sales budget in the Excel file. we need to report each month and the total budgeted sales in units and the dollar amount for the quarter. Let's take a look at it here. For each month, we know budgeted sales in units. This is a given. Multiplied by selling price per unit, and we can get total budgeted sales in dollar amount for each month. For example, for April, budgeted sales in units, 20,000, multiplied by selling price per unit, $10, and then we can get the total budgeted sales, $200,000. Keep in mind, to get dollar amount, we use units multiplied by unit price. We can do the same thing for May and June, and then for the whole quarter, budgeted sales in units, we add up together to get 100,000 units. Multiply by 10, you can get $1 million. Or you can add up for 3 months, total budgeted sales. You'll get 1 million as well. So the sales budget is straightforward. Next, we will take a look at expected cash collections table. Additional information. All sales are on account. On account, which means no cash involved, no cash received for sale. Row year's collection pattern is 70% collected in the month of sale, 25% collected in the month of following sale, 5% uncollectible. In April, the March 31st accounts receivable balance of 30,000 will be collected in full. This is expected cash collections table. We first insert the ending balance of accounts receivable in March as beginning balance of April, because accounts receivable is a permanent account. Permanent account will not be closed at end of accounting cycle. The balance from last period will be carried into next period. So the ending balance in March should be carried into beginning balance of April, and this amount will be collected in April in full, $30,000. Then let's calculate expected cash collections for April sales. From the sales budget, total sales in April expected to be $200,000. 70% will be collected in April. 25% will be collected in next month, which is in May. So we can calculate 70% of 200,000, which is $140,000. $140,000 cash will be collected in April. For May, 25% of 200,000, which is $50,000, will be collected in May. For May sales, total sales $500,000. 70% will be collected in May, which is $350,000. 25% will be collected in June. For June sales, total sales $300,000. 70% will be collected in the same month. So $210,000 will be collected in June. 25% will be collected in next month. Currently, we are preparing the expected cash collections table for the quarter ended June 30th. So we only prepare for April, May, and June. July collection is not on this table. So 25% of 300,000 will not be put here. In the beginning, the question has told us 5% will be uncollectible. For uncollectible accounts receivable, we should report it as bad debt expense. In Intro to Financial Accounting class, you've learned the journal entry for uncollectible accounts receivable should debit bad debt expense, credit allowance for doubtful accounts. No cash involved. So here, 5% of uncollectible should not be reported. For the quarter column, total cash collections for this quarter, if we add up together, it should be $905,000. After we finish the sales budget and expected cash collections table, we can prepare a production budget. Based on the sales budget, we must make sure the production budget is adequate to meet the forecasted sales and to provide for the designed ending inventory. We want inventory on hand at the end of the period to minimize the likelihood of inventory stockout. Let's take a look at additional information. The management at the Royer Company wants ending inventory to be equal to 20% of the following month's budgeted sales in units. On March 31st, 4,000 units were on hand. And let's prepare the production budget. Here, please note, Royer Company is a manufacturing company, so we will prepare a production budget. If it's a merchandise company, then we should prepare a merchandise purchase budget instead of production budget. Let's take a look at here. To prepare the production budget, we can follow the formula. Budgeted sales in units plus designed ending inventory. We can get the total needs. Minus beginning inventory, we will get required production in units. For budgeted sales in units, these numbers are given. The whole quarter, we add up together, we will get 100,000 units. For expected ending inventory, the management at the Royer Company wants ending inventory to be equal to 20% of the following month's budgeted sales in units. So for April, we can calculate designed ending inventory should be 20% of budgeted sales in units in May. So we can use 50,000 multiplied by 20%, and we'll get 10,000, which is designed ending inventory in April. Added to April's budgeted sales in units, we can get the total needs 30,000 minus beginning inventory. Beginning balance in April is the ending balance in March. Inventory is a permanent account. The ending balance from period 1 will be carried into beginning balance of period 2. So we put 4,000 here and subtract 4,000 from total needs to get required production in units for April, which is 26,000. For May, budgeted sales in units 50,000. Designed ending inventory should be 20% of budgeted sales in June. So we can calculate 20% over 30,000, which is 6,000, is a designed ending inventory for May. 50,000 plus 6,000, and we can get 56,000 for total needs. Minus beginning inventory. Here, beginning inventory in May is the ending balance in April, which is 10,000. So we subtract 10,000 from 56,000, and then we can get 46,000. For June, budgeted sales 30,000 units. Add designed ending inventory. Ending inventory here, we can make assumption. For this question, we can also calculate from July's budgeted sales in units. If you go back, take a look at the question, it has told us July budgeted sales in units, 25,000. So here, we can also calculate 25,000 multiplied by 20%, and then we can get 5,000. If the company does not have July budgeted sales in units information, then for the ending inventory in June, the company will make assumption based on the previous quarter or the same quarter last year experience. Now for the quarter column, total budgeted sales we already know 100,000. For the designed ending inventory for the quarter, we use 5,000, which is ending inventory balance in June. Think about it. The ending balance of this quarter is the ending balance in June. That's why we will not add up together here, okay? But we use ending balance in June for the ending balance of the quarter. And add 5,000 to 100,000. We can get the total needs for the quarter, 105,000. Minus beginning inventory. For beginning inventory of the quarter, that's beginning inventory in April. So we put 4,000 here and subtract 4,000 from 105,000, and then we can get required production for the quarter, 101,000 units. Keep in mind, for the production budget, based on budgeted sales in units, we budget required production in units, not dollar amount.